Guys, I know this is a bold claim, but I really want you to stick with me here. I'm going to show you a brand new way to become a millionaire in the stock market. I'm talking about a very simple, powerful plan you've never in your life heard before. And I guarantee, and that's a strong word, that over a long period of time, it'll beat the market and create millionaires every single time. And in the next few minutes, I'm going to show you exactly how it works. So, you've never in your life heard this before. We actually scoured YouTube before making this video. And what we found was pretty shocking to all of us. Everyone is talking about AI stocks to buy or how to time the market, but nobody, and I literally mean nobody, is talking about this approach. This video isn't some generic how to invest advice. It's a specific strategy, one that's backed by real data. One that's actually emotionally hard to do, which is probably why nobody else is talking about it. But if you can do it, and if you can surround yourself with people who will support you along the way, it absolutely will work, both logically and when we went back in time and tested it. So let's jump in. Now, if you're new to this channel, you will know that I very much believe in valuation. What that means is I look at history, and I look at the stock market, and I look at two major metrics, the stock market to GDP ratio and the 10-year cyclically adjusted PE ratio. And they both scream that we're overpriced right now. But forget about that. What I care about is how it is in history. And I want you to remember that it makes full logical sense. The more you pay for something, the less your future return is going to be. The less you pay for something, the more your future return is going to be. As an example, this iPhone, if it's worth $1,000, if you pay $900 for it, you make $100 on $900, which is 11%. If you pay $500 for it, you make a $500 profit on a $500 investment, you make 100%. If you pay $2,000 for it, you lose 50%. That's no different in investing. But what happens is we get caught up in stocks going up and up and up, and we have FOMO, and we got to chase it. This strategy is all about paying attention to market valuations. So the strategy is very simple. You pick a dollar amount. For this example, I'm going to call it $500 a month. When the market's overvalued, you invest $500 a month. When it's undervalued, you double that up, or you at least increase it by some amount. That's it. All you're doing is adjusting your contributions based on where valuations are. And the reason we talk about this is we talk about how important it is to always stay investing and dollar cost averaging. So this allows you to do that, but it allows you to put more chips in when the numbers are on your side. So very simply, guys, if the market is expensive, you stay steady. If it's cheap, you double down. This isn't guessing. This isn't timing things. This is a value-based investment approach applied to your dollar cost averaging strategy. And if you do that, not only do you become a millionaire, you crush the market over time. Now remember, guys, here's my disclaimer. I said earlier that I guarantee. Remember, the hard part about this is I'm using back data. So if the back data replicates here, it works great. But remember, there's always emotions, and it's scary when stocks fall. I always tell the story about 2005 and 6 when I had two friends of mine, they'd just gotten married and said, Paul, we want to start saving. Can you meet with us? And we talked, and I said very bluntly, guys, if the market falls 50%, what would you do? And the wife looked at her husband, looked at me and said, we'd buy more, right? Because she thought it was a trick question. I said, exactly, you get it. Then 08 happened, and I get a frantic email from the wife. Paul, what are you doing? This is so scary. I said, well, we talked about this, and I'm buying more. You're actually buying more? Yeah, we talked about this. I don't know. It just seems like stocks are going to go to zero. And that's exactly what she said. Stocks are going to go to zero. She pulled everything out of the market. And for a short period of time, she looked right because the market went further down. But they took way too long to get back in. Guys, it's easy to say when stocks are up that if stocks fell in half, you'd buy more. But you got to remember, then the story follows the stock prices. And suddenly the story is the world's falling apart. We're never going to rebound. Just like the opposite is happening right now. The world's going to continue on going great. Stocks continue to go up and they never go down. So it's very important that I say the word guarantee very loosely, only as a shocking statement. At the end of the day, nothing is a guarantee in investing. But what I do know is if you dollar cost average, then you will do very well in the markets. You won't have to guess what's up and when things are down. you will match the market. And all this strategy says is when things are undervalued, you put more in. So let me go show you what it means when stocks are undervalued versus overvalued. So guys, this is my stock market to GDP ratio going back as far back as I can go, I think upwards of like 1900. I do acknowledge the world's a very different place today than it was back in 1900, but it makes logical sense. As the US GDP grows and grows, the companies within it should grow along the way. And it's not possible for the companies within that GDP to grow at a much faster pace infinitely than the US economy, because then the companies would become bigger than the US economy, and that's just not a feasible thing at some point. But you go back here and you look at history. Look back at 2000. We had 50%, close to 50% overvaluation. This is the 10-year return. The next 10-year returns, not including dividend, negative. Okay, great. Now let's go to times when we were undervalued. Just a few years later. And guess what? It goes to a positive 5.5%. Now let's go back to 1982, like the lowest part of the market. 1982, we were 65% undervalued. The next 10 years, 14% returns, not including dividends. The more you pay, the lower your returns. The less you pay, the higher returns. This is not rocket science. If you go back through history, going all the way back in my data, it goes the same way. In fact, when I ran a correlation, there was a negative 0.82 correlation. What that means is -1 is the strongest inverse correlation. The higher valuations were, the lower returns. Negative 0.82. Just trust me that that is a very, very strong negative correlation. So guys, I went and back tested this in the next sheet. And I sat there and said, not including dividends, what would happen? Guys, from 1928 until now, you would have 9.5 million versus 6.3 million if you followed this strategy. 50% more money. 1985 to now, 1.3 million versus 695. Almost 100% more money. 2000 to now, 328,000 versus 204,000. Not including dividends is the big factor here. This is what's incredible. Every single time we did this, over a long period of time, 25 years, it worked. And guys, it makes sense. You're turning off the thinking. You're not chasing headlines. You're buying real businesses in the stock market at good prices based on valuation. And when the valuations are in your favor, you up the ante there. Now, why is it hard to do? Guys, it's simple, but it's not easy because this and this gets involved. When the market's down, news follows the stock prices. When the market's up, the news follows stock prices. Recession's coming. This is the worst market in decades. Well, you should give up on stocks. In fact, in 1982, Barron's magazine, at the worst valuation metric in history, like I showed you before, of negative 66% undervalued, it had an article that said the death of equities, as if you can't make money buying stocks. Everyone's going to be selling. The news is terrifying. Your emotions are screaming. And yet that's the moment where wealth is made. Guy Spier wrote a book called The Education of a Value Investor. And he talks about the same time period of the great financial crisis. And he said, I had all my value investor friends and we loved the idea of stocks falling. And then stocks fell and they were bailing. And I was like, wait. And he said, and I was thinking, wait, I thought we were waiting for this moment. That's what makes it difficult. Even these seasoned investors were bailing. Guys, the best opportunities rarely feel good. That's why we say you need a community. That's why we say you need principles. You need tools to block out all the noise because the 99% of people out there are going to fold. Are you part of the 99% or are you part of the 1% disciplined investor? That's the goal here you have to figure out. And by the way, you might not be part of that 1% yet, but the goal for you is to be aware that there is a better way of thinking. I remember thinking to myself, listen, value investing is a hard thing to get around. But if we go on YouTube and we build this community amongst 8 billion people in the world, we will find several million who can agree and think the same way. That is why we created it. I love the teaching. So guys, what's important to me is you got to have the right tools, the right mindset, the right people around you. Guys, you're going to end up being the average of the 5 closest people to you. Make that group our group. Join our community. It is a great way to get the right mindset, all of these tools to make better and better decisions, all at the tip of your fingers right there, ready to go. But the guy, there's a big key is, if you're not part of that person who wants to be disciplined or who is already disciplined, it's not going to work for you. And you're just going to be wasting your money. And that's not the reason to join. The reason to join is you're already disciplined or you realize you need to be more disciplined. If that's you, it is going to be the best investment you make. So guys, click the link below, join the community. We have a 7-day great trial for you to test it out. But in the meantime, for the future, stick to dollar cost averaging. Adjust your contributions based on valuation. Use the tools to know when the market's overvalued or undervalued. I want you to ignore hype. I want you to dollar cost average, and if you choose to buy individual stocks, to have the right tools and mindset, because it's even harder on individual stocks. So if you can't stand the market going down 20%, it's going to be hard when you see an individual stock go down 50%. But if you understand the fundamentals, if you understand what it means long-term, when a stock goes down 50% that you know and love, as long as the fundamentals are the same, you are going to be looking at it and saying, I cannot wait to buy more. Guys, if you're in your 20s and you do this consistently, you will absolutely become a millionaire. If you're in your 40s and you follow this through to retirement, it's going to be close, but you're likely to retire with more than you expected, and that's the goal. Guys, we can't make up for lost time, but you can start today 100%. Now, guys, if you're just interested in knowing how much you're going to have for retirement, we do have this great retirement calculator that's used so much in our community. It's a great way for you to just get involved and say, okay, what do I need? What do I have? How much do I need to survive? That's the big key. Because guys, getting the right money, hearing $5 million or $2 million or $1 million at age 65 sounds awesome, but you need to know how much it means and how much you need to live the rest of your life. Now, the great news about my strategy is this works no matter what the market does. Now, you might sit there and say, well, what if the market stays down forever? Well, the market stays down forever, and you truly believe that's going to happen, then you're not ready. You're not ready to make this decision. It is a valid concern, but remember, markets never stay down forever. And eventually, when the markets do start to rebound, they explode, and they do awesome. From 1966 to 1982, the S&P 500 was 100% flat. 107 to 110. From 1982 to 2000, it went up almost 15 times. So if you're 40 and you're looking at that 1982 to 2000, you're still not going to be retired by then. You can see your money skyrocket incredibly. And if you don't, and you're 40 and you're in the 1966 to 1982 time, guess what? Good news. When you're getting ready to retire, the market would have already been rebounding, and you'd probably be able to see your money grow further. I was on a cruise back in October, and I met a guy who told me his father retired in 1983. And he said, listen, he had this much money and he needed to live off that for the rest of his life. He retired early. He was 50. He goes, Paul, when he died 2 years ago, he had double the money after taking money out of that account every single month to live off of. He still had double the money he had back in 1983 or whatever it was. That was incredible. Why? Because he retired at the time when the market was about ready to explode. That's what's huge. So he lived off that money for 40 years and still had double the money that he started with. Guys, investing is about guessing the next move, the next perfect NVIDIA, the next perfect Tesla. About making sure you're buying assets at great prices over time and let compounding do the rest. As Charlie Munger says, the worst thing you can do in investing is to interrupt compounding needlessly. Let it go. You're going to buy during bull markets. You're going to buy during bear markets. There's going to be lost decades. There's going to be global recessions. Guys, everything possible that could happen wrong will happen in your lifetime. But if you follow this plan, you don't have to think about those. You just do it the same way month after month. So guys, you might be wondering, well, how do I know the stock market's overvalued or undervalued? Well, guys, every Monday in our community chat, I announce the two market valuations. The stock market's GDP, where it's at currently, it's a percentage overvalued, and it's fair value. And I do the same thing with the 10-year cyclically adjusted PE ratio. I do this every week. So if you're in the community, you can see that every single week, and you'll be able to make your decisions based on that. Now, guys, the truth is this. Most people won't do this. Most people love chasing the hype. Most people will try to time the market, and that's why most people will fail. But you're here, and you've just learned a new way. The question is, what are you going to do with it? And now, if you want to see how I've actually been putting this into action, early this year, I picked my own personal 7 stocks that I call my own personal Magnificent 7 to go head to head with the real Magnificent 7, the most hyped and exciting stocks in the market. And my 7 are stocks that I currently own and that are considered boring and don't have much potential. Click the video because I want you to watch this. The results will absolutely surprise you. Thank you for your time.